Every morning, we take a quick review of the market open in Asia and direction of travel for the day. And on a Monday morning, always a sense for the week ahead. Monday, May 17th. Let's kick off with our regular Monday morning commentator, Omar Nerjia, Global Head of Derivatives at BB Energy. Omar, good morning. Oil markets in Asia have opened this morning, essentially little changed after a fairly big jump on Friday. What's your take this Monday morning?
Well, nothing very much is moving, either oil or equities. And you have the market trading at about whatever it is, 75 and change. And it's got basically resistance above at 68 and support below at, call it 63. So basically, plus or minus $2 either way. It's right in the middle. And we wait to see which way it wants to break out, upside or downside. For the short term, trend, however, is higher over time for both markets, I think.
And what we saw last week, Omar, despite all the turbulence that the trend, as you say, was still upward. The market did close higher than the week before. It has done so over a few weeks, if even just incrementally so. We had said a few weeks ago that we might be stuck in this range for a short period or perhaps a protracted one. And you obviously were hoping for the shorter one. But how do you see it now from the point of view of this sort of range bound? We got stuck there for a few months last year. Now we're a few weeks in this one. What's your sense of its outlook?
Yeah, I think basically, as I was saying, the market set a high at plus or minus 68. It set a low when it corrected after it set the high at 57. And it's basically somewhere in the middle now. So markets, basically what they do is once they set a low or a high, they consolidate and then break out in the direction of trend. The question is, longer or shorter. Longer, if we break this $63 support, say, then we test more to the downside, then it takes longer basically for the trend to reassert itself, the trend up basically. If we break out to the upside and we take out that 68 high, then obviously the trend is reasserting a lot quicker. And if we go to the upside, and targets for me for WTI, somewhere between $72 and $78.
Let's bring in Mark Oswald, Chief Economist and Global Strategist at ADM Investor Service International. Good morning, Mark. News this morning out of China, industrial growth slowing a little bit, but still looks pretty strong numbers. Your take on the data out of China this morning?
Yeah, the industrial production numbers, basically, I think the overall impression from the Chinese data is we were hoping that there was going to be a little bit more pickup in personal consumption, private consumption, so that there wasn't so much reliance on industrial production. And actually, it's turned out to be the other way around. Production still very robust, 19.9, paced above all by the steel and aluminium sectors, which both saw record levels of output. The steel one is probably the one which is the big concern, because this is coming despite ordered or instructed restrictions on output from the local authorities, which may well intensify. I think the interesting aspect of the production data was that the Stats Bureau warned that particularly smaller downstream manufacturers in China are struggling with rising input prices. And that's across the board. It's not only energy, but it's also industrial metals. And they've already issued a veiled threat to make some sort of intervention. Now, the Chinese production story or the Chinese demand story, whether it's in the industrial sector or whether it's in the agricultural sector, is clearly pivotal to the strong demand that we're seeing for commodities at the moment. The only disappointment really in the Chinese data was the retail sales numbers, which came in at 17.7. The expectation was 25. You've still got a lot of strength in the property sector, again, another sector with curbs supposedly in China. So it is this intervention from the regulatory intervention in China and the other interventions, which perhaps remains the greatest threat, particularly with so much uncertainty about demand. If you're looking at what's going on in East Asia in terms of the pandemic evolution, let alone what's going on in India, there is still concern that this rising demand that we expect for pretty much everything isn't cruelly going to evolve along the timelines that people are expecting.
Now let's bring in Victor Yang, Senior Editor at JLC Network Technology, sitting in China. Victor, welcome. Despite the sort of uncertain outlook from the data this morning, we also have China crude oil throughput data for April published today out of China, showing a 7.5% rise in April from the same month a year ago, but perhaps a little bit down from the sort of super months of the last quarter of 2020. What's your take on the China April crude data?
Well, the year-on-year surge is no surprise. Well, as first of all, we had a relatively low base last April. Well, the throughput was not all back to normal yet last April. I mean, in April 2020, and so this year, and with the resumption, well, with the consumption, the industrial production all back to normal, actually growing from the same levels in 2019, and well, more capacity, refining capacity to say two large refineries came online during the middle of last year until last April. And on the one hand, China is now pushing forward with the transition to cleaner energy, but on the other hand, refining capacity is still rising. And for the government is trying to remove small refineries with outdated capacity, and I might say outdated units. But independent refiners are large taxpayers, and they are critical to local government's revenue. So, and they involve a lot of employment, and so it's very difficult to get rid of these outdated units all of a sudden. It will take quite a long while, and the capacity will keep growing in the coming years until say probably 2025. So a lot of traders will focus on demand for oil, but actually some other companies will focus on the country's transition to cleaner energy, because this also gives them a lot of opportunities. And last week, the government announced consumption tax on some imported products, mainly including diluted bitumen, mixed aromatics, and light circle oils. Well, so traders are also paying a lot of attention to this, because the tax will make some impact on the oil market. Say for diluted bitumen, say we actually know the so-called diluted bitumen is kind of sanctioned crude oil, and the imports has surged since late last year. Say now about over 2 million metric tons per month in Shandong. So it has made a dent in the imports of some other grades, some other heavy grades. So when the government implants the consumption tax on diluted bitumen as from June the 12th, say next month, and the imports of diluted bitumen would surely plunge, because of this would push up the cost very sharply and made the diluted bitumen lose its price advantage. So for some other grades, this would be great. Say some other heavy grades. And for light circle oil and mixed aromatics, there would be probably growing demand for standard gasoline and diesel in the Chinese market, because a lot of light circle oil and mixed aromatics are used. It's used to blend substandard gasoline and diesel, particularly in coastal regions. Well, this has actually dampened the demand for standard gasoline and diesel quite significantly. So this would be a good news. Well, good news for the gasoline and diesel market too. Yes.
Omar, your outlook for obviously the coming months, maintaining an upward motion and a sense of the trend line is moving upward. Prices incrementally, as we noted earlier, each week have closed higher. I'm wondering, do you have any concerns about the emerging supply shortages, supply disruptions, bottlenecks, etc. we're seeing in many different places? African copper suppliers can't find cargo ships to take their cargoes. We've got shortages in housing, building equipment availability. There's just a lot of places where shortages are emerging. What are your concerns that could stall, disrupt the trend line that forecast global growth this year over 5%?
Look, I think basically, I mean, a long time ago, back in, I can't remember, February or March, I was saying that the problem that we're going to get, everybody was agreeing that, yeah, we're going up and all this kind of stuff. But the problem that we're going to get is we're going to get dislocations, which is what we're seeing now between demand and not supply, but the abilities to supply on time. And why is that happening? That's because everybody not deleveraged, everybody destocked. So for example, you had 10 planes, you, I don't know, sold 5 of them, you now have 5. You had 10 pilots, you retired 5, you kept 5. You had 20 staff working in your restaurant, now you've got 2. You had 3 receptionists answering the phone, now you have 1. So that kind of destocking is basically a natural reaction to, the downturn that we had. Now, as the upturn ticks in, then people basically, they get to be risk averse. They're like, well, let's wait for demand, let's wait for demand. By the time demand comes, everybody's scrambling because, you want to hire receptionists, so does everybody else. You want to hire staff for the restaurant, so that you want plane seats, so does everybody else. So that's what we're seeing. So it's not kind of, supply and demand as such, but it's a kind of dislocation in timing. So what you see is you'll see spikes in price, and those will eventually come down because people will hire again, get moving again, all this kind of stuff, and that'll balance out over time. But that's kind of, the kind of short-term, expectation. Longer term, what you have is basically a lot of economies which are flush with cash, debt, whatever you want to call it. So this stuff has to keep going. This management of the economy, this management of the oil space has to keep going. You can't have people basically sit back, and that's the problem. So it started back in, you can argue 1980s, 2008, whenever you want, and it's getting more and more and more and more hands-on, and they'll keep going, and the train will accelerate, and we'll keep chugging along quicker and quicker and quicker and quicker, until one day we go completely off the track and everything crashes. So, have fun or make hay when, yeah, go ahead.
The in between, Mark, there could be a sort of middle ground. I mean, we saw the OECD, IMF in March, only 2 months ago, upgrade global economic growth by quite a significant number. I think it was from 3% to over 5% for the world economy. Your thoughts on the growing sort of winds against that? The idea of the supply disruptions, the issue of COVID resurgence, poor vaccine rollout in many parts of the world. Do you think those numbers we saw announced in March get challenged, may have to face a revision?
No, I think quite the opposite. Sorry.
So I was just going to go to Mark on that. Yeah.
I think that the problem here is these forecasts are going to be constantly revised because there isn't actually that much visibility. We've got a lot of supply chain disruptions. I think the biggest one is still everything that's to do with semiconductors. That's the one which worries me most. Everyone keeps on telling me technology will push prices back down once we've gone through the supply bottlenecks. Well, if we don't have the semiconductors, it ain't going to drive it down. And particularly as Omar was just talking about, we're going to be both using more technology to replace people. So we need more chips. And we're also basically going to find ourselves in a changing world, which rapidly changing. A lot of what's going on at the moment is basically just a high-speed acceleration of what was a work in progress beforehand. So you're now going to be coming out of this recovery, and everyone's going to be, a lot of companies have had huge revenue hits. They've scaled back. What they won't want to do is scale up and basically still be paying for all the debt. And I think this is really the big risks as we go forward over the next couple of months are, one, as the Western world, above all, starts to remove some of its schemes in states, you're already seeing a lot of individual states removing unemployment benefits, no longer participating almost with immediate effect. And that's going to create, I think the biggest risk is that we see a surge in unemployment as we recover. And that's going to really drive the private consumption story off the rails. So it's a combination of, if we don't get the chip story.
We have that, the unemployment. We already have the unemployment, but we also have the issue of removing the enhanced subsidy that sort of furloughed workers have received in the last 12 months. That's all going to start coming off in the next 6 months.
Yes, and that's that, along with all the supply bottlenecks, is the biggest risk, because as we roll back these schemes, whether it's the furlough schemes, whether it's the support rent arrears. In the UK, for example, there's they're going to be, as of the end of June, they're basically going to be allow landlords to make claims for rent arrears. What are those small companies which have been not paying their rents going to do then? So this makes for a real big stop-start sort of type scenario, and it's going to be very stuttering. It's going to be hugely uneven wherever one looks. And I think what people don't really appreciate is we had a house of cards. It's been blown over. We're trying to rebuild it, but we won't rebuild it in the same way. And that's really where the big tricky stuff is, because you don't really know, if you're a company reopening, unless you're in sort of some of the manufacturing sectors, you really don't know what demand's going to look like. So in a lot of cases, particularly given a lot of false starts already related to the pandemic, people are going to err on the side of caution, which will create price pressures.
Victor, we're all sort of hoping China continues to be the stellar performing economy. We're seeing slowly repeated warnings about the sort of credit rating, the debt burdens in China. We've seen in recent days reports that Chinese rating agencies have tripled the number of corporate bond downgrades that they've issued in China. What are your thoughts? How concerning is the Chinese internal credit issue regarding economic recovery?
Well, we see is tightening from last year slightly as well. And that's because, actually last year, the government is lending quite significantly to boost economy recovery and, industrial production. But now it's just like kind of getting back to normal, slightly back to normal, say before the pre-pandemic level. And say for some, it's quite necessary, because say for the real estate industry, the government, is lending to the industry, to the real estate industry. But this was quite, it was running kind of counter to this policy before the pandemic, because the government was trying to, restrict lending to the real estate industry so as not to rely so much on the real estate industry for economic growth, as it's trying to switch from the old economic driver to a new one. So in my opinion, it's quite necessary to tighten landing gradually again. But at the same time, the country's economic growth will be more, will depend more on kind of what we call high quality development, the transition to a higher, standard, say like in the energy market, say the removal of small refineries, when large ones are built, and the use of more alternative energy, say like electricity, wind power, hydrogen, and so this is kind of movement the government is taking for further economic growth in the future, not just for the short run.
Victor, also, we've seen reports this week, or last week rather, that the global glut in oil inventories that were built last year have come back to 5-year averages, at least in sort of OECD. What is the situation in China? I know last year there was a big build in the strategic inventory there, up to 100-day cover. Is that still in place?
Yes, I would say the bill was quite large last year, so the stocking is now slowing down. So in Shandong, just 2 weeks ago, the crude stocks at ports, mostly for independent refiners, say hit a record high. In our record. So we can see from that the stocks are still quite high now, and so for independent refiners, also for Chinese refiners, they would kind of slow down the purchase, say in the second quarter, but now after maintenance, is coming to an end, say in May and June, probably in June, the refining maintenance will come to an end. And in May, is declining already. So this is kind of pushing imports back modestly, but the stocks are still quite high. Yes.
Okay, let's get the survey question in again on addressing the theme we've been bouncing around. COVID resurgence in India and other places, even now in the UK, it looks like the India variant is impacting the opening there. Inconsistent vaccine rollouts and supply bottlenecks will force downward revisions of world economic growth forecast for 2021. We saw the OECD upgrade to 5.6% in early March. Do you agree or disagree with this thesis that all of these combined factors will force a downward revision of world economic growth forecast for 2021, which were upgraded in March by all the major multilateral agencies to a very robust 5+, the US 6.5%, etc. So agree or disagree with this thesis, and we'll look to get some views of where this week is going. Omar, welcome your thoughts. It's Monday morning. As we say, prices little change this morning. We're also seeing gold having a bit of a rally. I don't know what the correlation with that might be. Nonetheless, your thoughts on that?
Yeah, I think basically the dollar index, I think, needs a new low. I think I was premature in calling for the dollar to rally. I think it needs one more new low below this 89% it got to on Jan 6. So whether it gets to like, I don't know, the level it gets to 84, 87, and then rallies a little bit from there, I don't know. But I think the dollar longer term is a bit iffy. But again, for going forwards, we need more data to see which way this market is going to break on oil, whether it be higher or lower, so whether it consolidates more or goes up. But in general, people keep talking about, COVID variants and really a new deadly one and a new more whatever it is one, and nothing changes. So deaths go down, infections go down, all the rest of it. India, basically, yes, cases going up, but they haven't vaccinated, or they're trying to, or whatever. But places that have vaccinated are doing fine, coming out of lockdown, all this kind of stuff. So the new variants and the new, I don't know what, the mutation, and all the rest of it, I think, is a bit of a kind of red herring, right? So I wouldn't worry so much about that. We wait and see which way this market breaks out. Trend-wise, the trend on commodities, the trend on oil, the trend on equities is going up, and it's going up not because of any kind of magic, but because of policies of central banks. It's that simple. The West is basically has service economies. They don't produce anything. They produce very little. Manufacturing is all in the East. It's all in China. So of course, basically all the Fed wants to, that's why the Fed basically gives money directly into unemployed people's or all Americans' pockets, because they want them to quote unquote consume, because that's how the economy runs.
Go out and buy Chinese goods. Mark, your thoughts on the week ahead? Obviously, the big day in the UK and other parts in Europe today, travel permissions opening, and to the beginning of that summer season of tourism, which are obviously a very big part of many economies in Europe. Your outlook for that and this week, any data points you'll be watching?
I think in terms of this week, in terms of markets, I agree with Omar there. The thing people need to always remember is, if you look at it in terms of whatever the Fed's doing and this commitment, we've got the FOMC minutes this week. I can't really see that they're going to tell us anything other than this long, rather boring narrative of we're going to be patient, we're going to be reactive, and the inflation spike is transitory. They don't know any more than we do, to be quite honest. So, but that's what they're going to do. In that case, basically, you're not going to see the sort of rise in bond yields above all US and German to the sort of levels which would start to drag away from riskier assets. If we go from 1.5% 10-year yield to 2% 10-year yield in the States, it's still supremely unattractive. Yes, it's better than 0.8. So the risk demand is there, and that's why I think we keep on having these little setbacks. I think really what we're seeing at the moment is the inflation story, and the pickup in commodity prices is driving greater volatility. It's not necessarily driving a bigger downturn. It's just driving greater volatility because people will get much more nervous. So yes, I think it's the Fed minutes, even though I think there are, it's the PMIs that we get at the end of the week. It'll be the anecdotal evidence in terms of footfall in leisure activities in Europe as we start to reopen that people will be looking at. And I think increasingly it's going to be this balancing between, okay, so things are reopening in Europe, in UK, in North America. What's the story in Asia? And as much as I think maybe most people should be discounting it by now, a cancellation of the Olympics would be a bit of a mental blow. There's no question about it. But it is all stop-start. It is this sort of, what we've got is basically news flow and central bank policies, which are basically going to drive greater volatility. And I think it's the volatility is in pretty much any asset class except for bonds, which is really going to be the key aspect of the next few weeks, next couple of months.
Okay, let's get the survey result before giving Victor the last call. 2-1 or more, 3-1 agree with the thesis of a revision downwards. Victor, your thoughts on the outlook in Asia? We're seeing increase, obviously the India story at the forefront of the COVID resurgence. Even today, Singapore are locking down schools again. There's a low threshold of tolerance in Asia for resurgence of COVID infections. Everything seems to get locked down, extension of further lockdowns in India's biggest cities. What's the position from China at this point regarding the resurgence of COVID in India and the surrounding countries in near Asia?
So, and first of all, we do not see any chance of the country of China opening up its borders in the near term. That's not possible. And well, so demand for the near future is still quite, to say the least, a little bit gloomy, I mean, say in Asia. And for China, we had a few new, I mean, indigenous cases, well, a few days ago, say last week. And that's after 22 days of absence of new indigenous cases. Well, and so people are now getting a little, say, in some regions, well, a little wary about the virus, and so more people are getting vaccination. So and now over 380 million people, I mean, doses of vaccination have been performed. So it is kind of speeding up the acceleration after the few cases of virus were reported in China, yes, these days. So we hope this progress will continue. I mean, this progress will accelerate further. So when people are getting immune to the virus, well, so there may not be such a concern in China, at least.
Okay, well, let's wrap it up there. I do think there is things to watch this week, particularly in the UK, where this Indian variant, which is landing in the middle of a very well vaccinated country, if the variant is unable, it doesn't take hold, doesn't cause impact, I think that obviously gives a great boost of confidence that the vaccination program is working and is facing challenges and overcoming them. And that inevitably is a very big positive. The flip side of that, of course, is the availability of vaccinations. We've seen in India, which is the biggest supplier of vaccinations globally to the COVAX program, hasn't been exporting vaccinations now for nearly 2 months. That obviously has a big impact on the spread and reach of the vaccination program across the world and outside of the sort of wealthy countries. And that slows down that sort of global picture. So the pluses and the minuses inevitably will be juggled all the time. But perhaps you're sitting on a beach in Portugal this morning looking for your banger and chips. You're Britain away from Britain down in Porto, and you'll be happier than a Larry. Thank you, Victor. Mark, as always, pleasure to have you. Omar, thank you as always as well. Monday mornings isn't the same without you. Thanks so much. Have a great week. Make loads of money, and we'll catch up in the coming